Hi, and welcome to our live quarterly market update from Morton Brown Family Wealth. Welcome to our new offices. Since we last spoke, we've moved up 2 floors in our building, and everyone's settled in and accommodated. Welcome, team. How are you guys doing?
Good morning.
Fantastic.
So this morning, our team of advisors, we have myself, Katie Brown, Cody Demmel, and Sean Roth. Here at Morton Brown Family Wealth, our goal is to be a positive impact on the experience people have with money, relationships, and life. We're a planning-focused firm. Here we talk about investments, talk about the quarter that was, the half year that was. It's really been an interesting year, and also talk about how to think about investing in this type of environment. We're going to start out today with a quick poll here. If we could pull up the poll on the screen, that would be great. I just want to ask a question about what's happened since the last time we spoke. How far has the market rebounded since the S&P 500 hit its low in April of 2025? So, enter in the results.
Yeah. Make sure to scroll down if you don't see your options.
Cody, I'll let you do the big reveal on the number. So we'll see the results coming in. One of the things, flashing back to the last time we talked in April, the nature of this crisis was a big topic of conversation, the tariff issues and all the things that were occurring at that time. And we talked back then about the likelihood that this could be a V-shaped recovery, that oftentimes these types of events, somebody makes a different decision one day and things turn on a dime, and you have to be a little bit patient. It can be stressful, but you have to be patient and kind of, making sure you don't miss the rebound. And that was definitely the case this time. So, all right.
I will end it, even though we've only had 30% participation in the poll, but I'll end it.
Okay, that sounds good. So we had a couple 10%, some 20%. Cody, what's the right answer?
So as of close yesterday, it is 30%. The chart we're going to go over in a little bit was at the end of June, which was around 25%. But as of close yesterday, we did bounce back 30% since the lows in April.
30% recovery. So sometimes that's a couple of years worth of returns just in the span of a quarter. This chart here that we're looking at, and Katie, we've been through a thing or two in the first 7 years of Morton Brown Family Wealth. We've seen a few high volatility periods, and I think the thing that's hard to remember when things are volatile is just how much those bounce backs can occur in the years that follow.
Absolutely. And I think if we've learned anything also over the last few years is things are happening faster. And depending on what the driver is, may also impact the speed, which is a lot of what we've experienced this year. But it is in that rapid movement, we talked about today our theme is resilience. The markets are resilient. And it may take different amounts of time, but a little bit of patience and, solid grounding in your plan go a long way.
Yeah. But this chart shows us here, when the volatility index spikes up, and we have periods like we did in April or like in the interest rate crisis of 2022 or COVID, when volatility spikes up, the 1-year returns, this is pre-2025, the 1-year returns are 18%. The annualized returns over the next 3 years are over 12%. Annualized returns over the next 5 years are 12%. And that is borne out. If you look at kind of post-pandemic, what the annualized returns are for the S&P 500, they're in that range. Yeah. What they've been post-Great Financial Crisis, they're in that range. So
and that's on average, not guaranteed.
Yes, correct. But that's all we get to work with. It's just we have to manage those expectations. And Katie, this is kind of the lesson learned. We think of what are the things that we take away as advisors and the way we talk to our clients about things. One of my big lessons from the first half of the year when we talk about resilience is that you have to hold multiple stories in your head at the same time. There's not one narrative that explains it all. And I think, have we solved everything on the tariff front? No. Is there world peace? No. All these things that were chaotic in the first half, yet the markets recover. Right. Or, there's just, and I think that's a tough thing to do, especially for people who might be leaning into the retirement conversation or leaning into maybe transitions of one form or another. that's a really tough thing to do. So to your point, you got to be grounded in your plan.
Yeah. It's also the reminder that what's happening in the world around us is often disconnected from what's happening that day in the market. Usually the markets are ahead of what's happening. They've already baked in a lot of the concern, a lot of the turmoil, a lot of the chatter that's happening in the background before it actually comes to the forefront. And that's a good reminder too, because you have to be careful making decisions based on headlines that are happening, because you might miss out on the rally that likely happens before the turmoil ends.
Right. I'm going to give credit to Sean Roth for this one. When we were doing our prep session, he had a great line the other day. He said, "It seems like people only have a memory for like 10 days. Doesn't it feel that way? It's like the thing that we were so worried about 10 days ago, we've forgotten about by a week and a half later. And the market's kind of got that lack of memory too. It's like, what have you done for me lately?" And, I think one of the things that, we're trying to make sure that we do in our planning process is look to see what's happening in your life. Because that's the big driver most of the time. It's the things that happen to you and the decisions that you make. The external stuff is always going to be a little bit of a storm.
Yes. And the thing that I loved about what Sean brought up with, that 10-day memory is that's such a great reminder to say, take a pause, take a break, revisit your plan, but don't necessarily jump into action. Let's see how things are still feeling, looking, 10 days out, and how you've taken what's happened around you and applied it to, okay, but is that me? Does that impact me? Do I need to do anything? So give yourself kind of that settling out period.
Yep, absolutely. All right, Katie, let's start leaning into the slides. You want to talk about how we're going to run this morning?
Sure. So welcome again, everybody. So excited to have participation this morning, and we do encourage participation this morning. So we have a chat box down in the corner of the screen. Feel free to post questions along the way. We'll do our best to answer them. There may be some things that we know we're going to hit ahead of time, and we'll let you know we're going to get to that. Otherwise, we'll make sure that we circle up on your questions. But we love interaction, so we're looking forward to kicking things off here. And Sean actually is going to be leading the discussion this morning on the slides.
Thanks, guys. So as always, we start all of these the same way. We always like to look at kind of the glass half full and glass half empty. So one of the things we wanted to look at, on the glass half full side is short-term bonds. Rebounded really nicely in Q2, especially after an interesting start to the second quarter, which we're going to go over here in a little bit. Labor market still continues to be very solid. And inflation is still creeping down. I think, slowly but surely is the trend there with inflation. On the other side of the coin, a big topic of our this morning is going to be around tariffs. We still have so much uncertainty about what's going on with tariffs and where they're going to land, and what deals are going to be made. So that continues to be a little bit of a driver. Federal government debt was downgraded earlier in May. And then, as we all know, there's just continued geopolitical concerns, in Russia, Ukraine, and obviously, in the Middle East with Iran and Israel. And, those things just kind of have continued in the second quarter. And I think the big thing here is nobody really knows all the effects that tariffs are going to have, especially on inflation. And we have a chart that's going to go over that here in a little bit. Yeah. So this chart, Q2 by the numbers, it actually shows different returns for the international market, the S&P, and the bond market over the last year. But if you can look right around here in April, you'll see that's the beginning of the quarter, and you'll see we took as we mentioned, the market did take a dive. And just like Katie and Dennis mentioned, within 10 days, we had that V-shaped return and bounced right back. So over the last 12 months, international markets up over 18%, the S&P's up over 14%, and the bond markets, up over 9.5%. One of the big things to look at here on the right side, you'll see the number 9. 9 is the number of all-time highs that the S&P 500 has hit in the first half of 2025. So that is not a small number by any means. So it's interesting, even with, having those first 10 days in April in the second quarter, we're still at 9 all-time highs in the first half of the year. And this number down here, 1%. So 1% is how much a 60-40 balanced portfolio outperformed if you just invested in the S&P 500. So that 60-40 portfolio is invested, evenly over U.S. and international and the global bond market, and that is up over 1% over than the S&P 500, which I think is really interesting.
Hey, Sean, a couple observations on this. Katie, you and I have talked about just some of the headlines. We always like looking at headlines and how they can be a little bit obviously overstated sometimes. How many times have you heard about the death of the 60-40 portfolio in the last few years? It's constantly, being diversified. There's no, in other words, diversification isn't working. This year, diversification is working and spreading that risk out. One other thing that I think is worth mentioning, one of my favorite, it's the markets are kind of like baseball. They've been playing baseball for 150 years, 160 games a year. And anytime you say something's happened for the first time, that's statistically meaningful because there's so much time and data. The markets are the same way. There's so much time and data. When something happens unusually, there's a stat that says if you miss so many up days in the course of a year, you miss most of your returns. You're right. If you miss out on the market rebound for 10 days, you miss out on most of your returns. In this case, last quarter, if you missed out on about an hour's worth of market movement on the initial bounce back after the tariff policies were, you see that initial spike up, we had a 10% up day, and then there was another 7 or 8% up day. If you missed the hour that those both turned, you missed most of the rebound, and so you couldn't get in to try and do it. So sometimes we have conversations with clients where they say, can we just get out of the market and wait till everything's fine? If you tried to do that, you would have missed most of this rebound. So it's just, again, lessons learned from the first half.
Yeah. One last point on this chart that I think is really interesting too. We're looking at 3 very different markets. So we're looking at bonds, we're looking at US, we're looking at international. To your point on diversification, if you look back here, about a year ago, bonds were outperforming. And then we move into, can you guys see my pointer?
No, not yet. That's Sean's.
Okay. Then we move into the US markets outperforming, and then international markets outperforming. Point being, we don't know who the leader is going to be when. That diversification is so important.
Yeah, and even more important, like Dennis, you just mentioned it, if you missed an hour of being in the market, you missed almost all of the return. So just taking, like Katie mentioned earlier, just taking a pause before making a really rash decision like that is really important.
Absolutely.
All right, so this chart shows is going to dive into tariffs, which I know is on a top of a lot of folks' mind. So this shows different dates with the basically the effective tariff date and different headlines. So see, it starts early February, ends at the end of June, and you will see all of the different headlines that we have had regarding tariffs, in just those short couple of months and how much they've changed. So, we started early February, just around 4% tariff rates. And then, middle of April, we're sitting up here at 27%. So it's really interesting to see how much it changes. And I think this chart shows us that, there's just a ton of uncertainty about tariffs, and it's going to continue to be that way. And it's really challenging for companies to, navigate this market on how they're going to handle tariffs, what they're going to be, so it's really just an ongoing conversation. It's ever changing. This week alone, we've gotten a few deals done, and who knows on the tariff side what next week will bring with different countries and regions on deals that will be done. But I think the thing to know here is that it's ever changing. We're always learning, about tariffs, and we're just not sure where the next deal is going to be, or if there's going to be another pause or hard deadlines that come.
Sean, I think if we're looking for kind of silver linings in all this turmoil and everything, especially if we look back over the last few years, changing business conditions are nothing new for the companies that you own. So if you own an S&P 500 index, that company has navigated, a global pandemic and its bounce back. They've navigated spikes in inflation. They've navigated tariffs. I mean, these companies are dynamic and have to make decisions to live in the environment that they live in. So I think that I think that's why we've seen the markets bounce back a little bit, is because these companies are adapting to this and figuring out what the new normal is.
Well, this chart breaks down manufacturing industries and service industries, and it shows their potential actions in kind of combating the higher tariffs. So the green is the manufacturing, that blue is the service industry. And you'll see they all have different strategies on how they're going to deal with the effects of tariffs. So you see a large number of manufacturing companies, have some thoughts of passing those cost increase on to customers. So that's things like, the inflation and the cost of goods. That's where that comes into play. And it's more than likely that companies are going to take kind of a varied approach where maybe part of those costs gets passed on to the customers, and then other times, or other parts of that cost will be absorbed by the company. They're going to have to find new suppliers. A lot of companies we saw moved up purchase dates of supplies before those tariffs, came into play. And some, unfortunately, are even just scaling down or, shutting down operations. But this chart does show that it does have more of an impact on the manufacturing side than it does the service industry. You see down here at the bottom, 14 of the service companies are going to say that they're just not doing anything regarding tariffs, probably meaning that they're just not affected. So it's going to affect the manufacturing side more than the service industry, but it's interesting to see, how they're going to, handle the different tariffs and different ways they can pass those costs on to customers or absorb them. One of the big things about tariffs is, how they're going to affect the global bond market, and Cody's going to go over those right now.
All right. Thanks, John. So regarding tariffs, obviously the major thought right now is how it's going to impact inflation and what that means potentially for the Fed cutting interest rates. So the Fed started cutting interest rates in the fall of 2024. They have not cut so far this year. They have another meeting next week. The expectation is they're not going to cut yet, just because, as Sean just went over, there is still a lot of unknown inside of the tariff numbers and how that's going to impact inflation going forward. So looking at Q2 for fixed income, it was a very stable market for fixed income. That's what we want fixed income to do inside of your portfolio. So over Q2, intermediate term corporates were up over 2%. Intermediate term treasuries were up almost 2%. Short term corporates were up almost 2%. And honestly, I think the most telling thing here is if we look at the last year. So going back to Q2 of 2024, over the last 12 months, even though the Fed had only cut a couple times in the fall of 2024, intermediate term corporates are up almost 9%. Intermediate term treasuries are up almost 7%. Short term corporates are up almost a little over 7%. Short term treasuries are up 6%. Getting these type of returns from fixed income means you can have that balanced portfolio. You don't have to take all the risk inside the stock market to get a very stable return. That's kind of what Sean went over in that one chart where I was going over the outperformance of a balanced portfolio compared to just being in the 100% US stocks of 1% year to date at the end of Q2. We are getting good returns from fixed income. I know one of the items we spoke about in some of our previous other market updates was one of the most important things to look at for fixed income is the starting yield. And we're still in a very good spot for the starting yield for fixed income.
Yep. Cody, that's kind of wild. I mean, you have almost stock-like returns coming out of bonds. And when Katie and I referenced in the beginning, first of all, we're not market prognosticators. We don't sit here trying to predict what's going to happen. We'd much rather be market historians to say, usually when circumstances are such, this can occur. So when volatility spikes really high in the stock market, usually returns are higher in the next 12, 36, 60 months. In the bond market, a couple of years ago, in one of these updates, I know we talked about what happens when the Fed stops a rate hike cycle. When the Fed stops a rate hike cycle, it usually means better returns for bonds over the next so many years. That's what you're seeing now. You're seeing that this is kind of the aftershock of the Fed stopping a rate hike, and suddenly the yields start to pick up, and this is the math. So,
No, that's a good point. And this next slide goes over that in a little more detail. as Dennis says, looking back at history. So this is looking back the last 25 years. So if we look at the title of this slide, we just named it Positioning in Cash, because we know, right now being able to get, a 4.5% interest rate on a money market yield is, pretty attractive. But when we're looking at money that you're not going to need in the shorter term, now is the time to, start looking and putting that to work, whether it's in, mostly fixed income, a diversified portfolio. Obviously working with your advisor, talking that through is the most important thing. But when we look back at the last 25 years, this top chart is the Fed funds rate. So you can see they raise it, they cut it, kept it at zero for a long time following the great financial crisis, raised it going into 2020, cut it from COVID, and then obviously raised it again to fight inflation in 2022. And then, as I said, started to cut at the end of last year, but stayed steady. If we look at this middle chart, this is the money market yield. The money market yield follows exactly what the Fed fund rate does. So again, this does make sense for very short-term money, but anything outside of, in the next 6 to 12 months, now is a very good time to start locking in the yield of fixed income, not only, for that 4.8%, this is intermediate term corporates, but also potentially for price appreciation, which we just showed on that last chart. If we look back over the last 12 months, you were getting around a 5 to 6% yield from US corporates, but you were up almost 9%. And that's because the price of the bonds that you held actually went up because the Fed did start cutting rates in the fall of 2024. I also think one of the most important things to look at is what the total returns were over the last 25 years for a money market fund compared to intermediate term corporates. Over the last 25 years, the total return from money markets was, say, 45%. The total returns for intermediate term corporates, even though you do have a little more volatility, was up almost 180%. So again, this is where it makes sense to obviously work with your advisor. If you know you don't need the money in the short term, potentially putting that to work in maybe a diversified portfolio, some in stocks, some in fixed income, but we are still in a very good environment for fixed income going forward. One other thing I'll point out, if you look at the money market from the great financial crisis till right before 2020, it literally did nothing. There was no yield in the money market, or even when the Fed cut interest rates for intermediate term corporates, you were still getting around a 3% yield. So locking in that yield inside of fixed income is very important. So skipping forward to stocks. So stocks obviously had a very interesting Q2. As we talked about briefly at the beginning, we sold off almost 20% from all-time highs in the beginning of Q2, bounced back very strong. So if we look at Q2 returns, best performing was large cap growth. So tech was hit the hardest in the beginning of Q2, but then also bounced back the fastest. But if we look at year to date, the telling thing is look at the difference in Q2 between large cap growth and large cap value. It's almost 15% the difference. But if we look at year to date, they are almost at the exact same place. So again, trying to time the market is almost impossible. It makes sense to do, some rebalancing when we have large sell-offs or when we have, large run-ups, which we're going to talk about in a little bit. But looking at year to date, you'll see international small caps up almost 21%, emerging markets up over 15%, international large caps up 19%, where US large cap is up right around 6%. And just a reminder, this is at the end of June. We have, continued to do very well over, the last three weeks. But this is where that diversified portfolio really comes into effect, that eventually the tides may change. You may see international outperform US like we have this year. And I know we spoke about that previously in some previous market updates, just based on where the valuations are. But this is why a balanced and diversified portfolio makes a ton of sense. One of the major things that's obviously top of mind for everybody is diversification. You hear on the news a lot about the Mag 7. So staying very high level. This chart on the left side, the green is the international large cap market, Europe. Blue is Japan. The gray is the S&P 500 just without NVIDIA. If you strip out just NVIDIA from the S&P 500 and have the rest of the 499 stocks, you are underperforming Japan and Europe by almost 20%. since the end of the bear market in the fall of 2022. So again, making sure you're diversified. As we just went over in the last slide, international stocks are outperforming US. One of the also other important charts is as I said, a lot of people talk about the Mag 7, how well they've been performing, how strong the bounce back has been from the bottom in Q2 that we just went over briefly in the previous chart. This is going over what the best performing Mag 7 was in a given year, the worst performing, and the average. Just look at the difference between the best performing and the worst performing. You have to pick which one. If you're going to invest, in one of the Mag 7s, you have to pick what is the best one or potentially the worst. Also to point out, this looks good looking backwards, saying, okay, I can take 50% returns. Maybe I was able to handle 44% because it went up 70. But honestly, in 2022, how would you feel if you invested, say, $1 million? It went down from $1 million to 350,000 because you had a 65% sell-off. That's where this volatility that we have in some of the US large cap, this is why we have to stay diversified, because it is so hard to pick individual stocks and continue to hold that, because you have very, very strong volatility, both to the upside and potentially to the downside. One of the other, go ahead, Katie.
I was just going to say, I think the other thing to remember too is right now it's the Magnificent Seven, but they're not always the leaders. That leadership can change, and we've seen that change. We've had previous leaders, and so you're right. You could say, I'm going to stick with this because they have had incredible returns. That may not always be the case.
Correct. Yeah, just a couple of years ago, it was FANG. It wasn't Mag 7. So it changes all the time based on what past performance has been. So looking past, obviously, as Dennis and you were talking about earlier, is important when you're looking at major asset classes. But for individual stocks, that is really tough to look at past performance and be like, oh yeah, it's going to continue growing at that pace.
Yeah.
I just had a meeting yesterday with a client who has a substantial position in Apple. It's a legacy position. It's lots of embedded gains. We're not doing anything with it actively, but he's like, why is my performance not where it should be? And I was like, it's that Apple position, Apple being down double digits this year has been a drag. But when we look at the long-term performance, it's been an incredible success. But you're right, that's where it's showing up now.
Yeah. I know oftentimes when I'm meeting with clients and we're talking about individual positions, I'll often say, because sometimes there is a preference to hold something, or there's a legacy position, or there's something else. It's okay to have a position that maybe will influence that performance a little bit, but be careful when that singular position drives the performance. Because if it's driving the performance, then you are introducing a lot more volatility and a lot more potential risk to the long-term plan.
Yeah, good point. So speaking on being resilient, this chart is looking at the S&P 500 over the last 75 years. So going back to 1950. What you'll probably notice first off is there's way more green. There's way more spikes in the green compared to the reds. The main reason we wanted to bring this up is being resilient, because if you look at how strong the bull markets are compared to the bear market, and just a reminder, a bull market is when the stock market is going up. A bear market is when the stock market sold off more than 20%. So the last bear market we had was in 2022. We were really close at the start of Q2 of this year, but as we just went over, we bounced back very strong. Honestly, the main point here is just staying resilient, staying investing. Obviously, these bear markets never feel good, but when you look at how strong the bounce backs are, as we always talk about, the trend is always up to the right. Obviously, you'll have some intermediate term volatility to the downside, but staying invested, doing the proactive rebalancing, which I know we're going to talk about in a little bit. So whether you have a very strong bull market like we did from the end of the great financial crisis till right before COVID, if you didn't rebalance, so say for an example, you had 60% stocks, 40% fixed income over those 10 years, you were probably closer at the end if you didn't rebalance to 80% stocks, 20% fixed income. So if you didn't rebalance, instead of only 60% of your portfolio selling off, over 80% probably sold off. So again, doing that rebalancing is very important. Obviously working with your advisor, talking through your risk tolerance. There's a lot of proactive things to do when we're, in a good spot, which we are right now, both on the stock side and on fixed income.
Yeah.
Cody, can I just point out one thing about this chart? I love the visual here of just the blips that are bear markets, that all those red marks are bear markets there. Cody, could you please take us back to 2018 and tell us that there's a global pandemic coming in 2020 and how long that recession is going to be and how long that bear market's going to be.
Yeah.
Look at that. I mean,
it's you can't even see
incredible.
like the gray that you can see in some of the other bear markets. It's just a little red dot down.
We had a 7.5 week long recession and a bear market that was a blip, and it was a positive year. So I think we fret about a lot of things as investors. We worry about like the what ifs. The one thing, all right, let's put the gray cloud on the silver lining here. The one thing that we think about is it's been a really long time since we had a recession or like something like the great financial crisis. Like you can see that kind of 18 months, 2 year window that was 2007 to 2009. It's been a while. So it's just something to be conscious of, is that we haven't had a recession in some time, and we haven't eliminated them. They can still happen. But I just think that last 15 years of market history is very interesting.
Speaking on that is why obviously it's important to talk with your advisor to do some rebalancing. Sean, I'll let you introduce these charts.
Yeah, so this chart is really interesting. If we start over here on the right side, you'll see these are valuations in the stock market. So see US, Japan, Europe, emerging markets, and China. What you'll see in US is the purple diamond is where the current valuations, and the long gray box is the 20-year range of valuations. The US market is still sitting at the top of its 20-year range of valuations. And if you look, if you go international, Japan, emerging markets, China, we're all still sitting right around the average of valuation. So I think what that shows is the U.S. market is still, at the very top end of its value or overvalued, if you want to say. And I think, we went over earlier in this presentation, how much, how well the international market's been doing, year to date. And then on the left side is where I think it gets more interesting is the bond market. So you'll see, this blue diamond is current yields in the bond market. While we're still higher yields than we've had over the last 15 years, there's still a lot of room to go. And as I think, Cody, you mentioned earlier, current yield is the #1 indicator for future bond performance. So I think there's a lot of opportunity in the bond market, which I think, over the last 15 years, has certainly been missing. And, if current yields are a great indicator of a bond market, I think one of the conversation points we're going to have is, and Cody, you mentioned, is, being in a money market versus being in short to intermediate bonds. Where's the benefit? Where's the long-term benefit that you get from that?
Great. I do think the one thing that stands out, if we focus on the chart on the right for a second, is the current valuation of the U.S. compared to, even though it's underperforming international, as Sean was saying, is still right in line with its 20-year average. Not saying that because U.S. is at the top end that it's going to have a massive sell-off, but it is just something to keep in mind. We are, over the next couple of weeks, a lot of the major companies are going to, go over their earnings calls, go over forecasts going forward. But this is something just to keep in mind. Maybe it may make sense to take some risk off the table if you haven't done any rebalancing. Work with your advisor. Maybe you don't need, the double-digit returns from stocks, and you can be, happy with a 5 to 7% return from fixed income. So again, this is where obviously working with your advisor, going through the financial plan is really important.
Yeah, and this is something we pay attention to. I think it was. Do you remember, Cody, a couple of years ago when I think it was Vanguard came out with their capital market assumptions, and they had lowered them pretty substantially. This is what institutions use to make their decisions about what to expect in the future. Like institutions like Vanguard will come out and say, this is roughly what we expect over the next 5 to 10 years, and they drop those assumptions. So it's all because valuations get higher. So it doesn't mean that you're going to lose a lot. It's just we have to dial back what our expectations are.
Yeah, and I just want to clarify for a minute too what we're talking about when we say rebalance. When we're rebalancing a portfolio, what we're doing is we're going back, we're realigning it to the strategy that has been set to support your financial plan. And so, going back to that asset allocation, what makes sense for you given your level of risk tolerance, what's needed to support your goals, et cetera, but making sure that we're not veering too far off of that strategy, because as we have different returns, and we've seen the returns zig and zag here, this year, over the past 12 months and beyond. And so you might find that you have more in certain areas of the market. Your equities, your stocks may have outgrown where you originally set that point. And as Cody said, and as we've been talking about, there's a lot of opportunity across a lot of different markets. So let's make sure that you're staying in line with that investment strategy that's going to support your plan.
Good point.
All right. Speaking of, focusing on things that really matter. Once again, financial planning is so important. It is what helps to keep us grounded, during periods of volatility. It's what helps to set, what you should be doing across the rest of your financial world, how that portfolio should be structured to support your plan. And planning is very personal to each family. It's very unique to each family. It's a process. There's never an end point. It changes because our lives change, but it's really important then to allow you to, focus on those long-term goals. And once again, it's very personal. It's not about beating the benchmarks, and it's about staying disciplined, making sure that you are rebalancing as needed, and that you are cognizant of, reducing any unnecessary friction, unnecessary cost, and that you're taking a broad approach to your investment strategy so that you are kind of reducing that volatility over time, but really kind of stay focused on what matters. And usually the best time to put in the good work is when things feel comfortable. When right now, we're at a good spot in the markets, and in most investment portfolios are in a pretty good spot right now. This is the time to really think, okay, what can I do? What can I do to take advantage of this time period and make sure that I am being productive, make sure that I'm staying in front of the things that I need to do to reach my goals in the long term.
Great point. Moving from a position of strength, so to speak. I think that's awesome. Well, listen, this has been a great discussion. Thanks everyone for your input. If you have any follow-up questions for us, reach out to a member of the team. We're happy to discuss this and go over any topics that we've covered so far this morning. But until then, hope everyone has a great summer. Wish you all the best, and thanks for joining us this morning for our live market update.